Okay. So, good afternoon or good evening, everybody. Thank you very much for the introduction. I'm very happy to be here, of course, today. It's a great pleasure to give this year's Barrington lecture as part of the Barrington Award. We're in the 179th session, of course, so there's a good bit of history here, tradition, almost 200 years ago, which is quite an accomplishment for the society. Of course, it's great to be receiving such a prestigious award, and I'd like to thank the Council again of the Society for bestowing such a great honour. I mean, it really is a fantastic award, especially when you have a look at some of the names on the list of past winners. So, very happy to join that group, and thank you again. So, today I'll be presenting some new research that I've completed relatively recently. As you can see or maybe infer from the title of the paper, I'll be focusing on the nonlinear dynamics of Irish inflation in the context of international co-movements. So just to be very clear from the outset, in a nutshell, what the paper really is about is kind of the extent to which international inflation is influencing Irish inflation. And I examined this kind of through the lens of this link between 1, international inflation co-movements, 2, the deviations of Irish inflation from international inflation, and then 3, the persistence of these deviations, or what I call idiosyncratic inflation persistence in the paper. And I do this in a framework that embeds non-linearities in the evolution of these deviations from international inflation over time. So that's really the first kind of part of the paper. And then in the second part, I follow that up with an analysis of some of the potential drivers of these core variables of interest, the inflation co-movements, the deviations, and the persistence of these deviations, and also the rate of adjustment in the inflation gap for Ireland. And hopefully, this provides us with some additional insights and intuition. So, okay. So, while browsing the web, I actually found this image pertaining to Irish inflation from a 2014 Irish Independent article, and it was talking about kind of the relevance of headline figures and whether they should be the focus of economic policy making. And I can very much relate to this image from my own study. I can see kind of the international dimensions of both of these statements, right? On the right, you might think about kind of the impact of, being the highly open economy of globalization, international competition, all of which have kept non-durable, semi-durables inflation relatively low, although there has been volatility in goods inflation as well over time. And then on the left, you can think about kind of the impact maybe of inward migration, perhaps attracted by the opportunities provided by foreign multinationals. 80% of our population growth is due to immigration. You might think also about, the kind of the impact of foreign institutional investors over time, foreign capital inflows through these maybe real estate investment funds and trusts, private equity firms. And then you might also think about kind of fluctuations in the cost of construction materials globally, all of which have added to this additional pressure on the housing market and created an upward pressure on rents as well. Right, so in that spirit and continuing with those kind of motivating observations on Ireland and the globalization of inflation and associated dynamics, there are at least kind of 2 main reasons why Ireland's ability to exert direct control or influence over domestic price dynamics is relatively limited. So firstly, Ireland is a small open economy that's heavily exposed to global macroeconomic shocks, right? So we're deeply integrated into international markets, embedded in global supply chains, significant foreign multinational presence here, right? So consumption, production, finance are very much dependent on international conditions. And then secondly, we're a member of the Euro area, of course, so our national policy toolkit really is void of, monetary policy or exchange rate strategy options. That's really all conducted at the supranational level by the ECE. Anyway, as highlighted by people like Janet Yellen, Mark Carney, Ben Bernanke, and others, one of the most contentious issues in monetary policy over the past decade or so at least has been kind of the extent to which inflation is driven by domestic or local forces as opposed to international factors. And this is important because of the central risk of overvaluing the impact of national policies in a globalized, well-integrated world. Right now, of course, given recent developments in the stagnation, globalization, if fragmentation effects really do take hold, and there may be some signs of that, but you could definitely argue going forward we might be placing more weight on national policies as the country becomes maybe more vulnerable to local or domestic shocks relative to foreign ones, perhaps in the face of fewer international diversification opportunities, right? So we actually have quite a rich literature on the globalization of inflation. There's a general consensus that domestic inflation, to a significant extent, is a global phenomenon driven by a common component. So according to some studies, such as that of Ciccarelli and Majon, published in the Review of Economics and Statistics, international or global inflation can account for something like up to 70% of national inflation variances. And this large share of the variance that's attributed to global inflation isn't just due to the trend component of inflation, so forces like globalization or the systematic component of monetary policy, but it's also due to fluctuations of business cycle frequencies, right? So despite all of this, there are still many that would argue that the sources and the dynamics of international inflation co-movements, the associated deviations from international inflation, and the persistence of those gaps are not well understood. And I guess that's partly because most studies to date have been focusing on the drivers of international inflation itself. So they assume this common component exists, and they ask, well, what drives that up or down? And they look at things like the VIX, long-term US interest rates, global commodities. While relatively few have looked at kind of like the underlying facilitators of these co-movements in national inflation rates, the things that really kind of bring into existence this common component, so maybe factors like openness, and that's something that I try to address, and of course has implications for international monetary cooperation and so on. Now, another closely related avenue that's not so well explored is kind of the extent to which these inflation co-movements are linked to the evolution of the sizes of these deviations from international inflation. So that nexus within the context of nonlinearities. So nonlinearities have been stressed at a particularly high level in recent times. If we look at the ECB's relatively recent assessment of its monetary policy strategy, it indicates that large economic surprises can induce these very pronounced nonlinear price effects that cause inflation to respond more strongly. So what they're talking really about there is the idea or notion of state dependence, this kind of nonlinear pass-through from marginal costs to inflation whenever you have large shocks, kind of a deviation from standard kind of Calvo pricing maybe models. And they also indicate that looking through transitory fluctuations is still a valid response, unless of course inflation becomes more persistent and there are incipient increases on the horizon, in which case the monetary authority should react more aggressively. And this is kind of, I think, a challenge that they're currently facing. They're waiting to see what's going to happen. And so these different kind of things that I'm highlighting about nonlinearities, these different ideas, they do cross over to what I'm doing, and the different facets of inflation dynamics that I'm highlighting, that the co-movements, the nonlinearities, the deviations, they're all very important when it comes to accurately capturing reduced form estimates of inflation persistence and also our understanding of the underlying sources, both of which feed into inflation forecasting and help with assessing the effectiveness of monetary policy actions. Right. So, So, what is the contribution of this paper? Well, there are several. So, firstly, kind of based on a preliminary analysis, I offer kind of an assessment of the universe of correlations between Irish inflation and international inflation at both the aggregate and more granular levels. Then combining the three aforementioned strands of the literature on the globalization of inflation and nonlinearities and persistence, I model the idiosyncratic inflation dynamics of Ireland. So put simply, what I do is I study the evolution of these deviations of Irish inflation from international inflation and examine the persistence of those gaps in a nonlinear framework. The nonlinearities are manifested in the form of asymmetric inflation adjustments over inflation gap sizes. So that's the form of state dependence here. And I do that for headline, core, goods, and services inflation, right? And then using the results from the nonlinear framework, I look at the link between international inflation co-movements, the deviations of Irish inflation from international inflation, and the persistence of these deviations. So that link isn't so obvious. So, while stronger co-movements can indeed result in weaker deviations, so can weaker co-movements in some cases of a divergence in competitiveness positions across home and foreign markets, right? I also use the results from the nonlinear framework to study the evolution in the rate of adjustment of the inflation gap for Ireland, which gives me an idea of how market frictions for the country have evolved. And it also allows me to decompose inflation gap persistence into its underlying channels and get an idea of how that's evolved over time too. And then finally, I look at some of the drivers of these core variables of interest, co-movements, and so on. And the neat thing about the framework is with the decomposition of persistence, you get to see how each driver acts through the different channels to produce the overall net impact on inertia. Okay, so right, so what do I find? So overall, you might not be surprised by this, I find that there is a strong positive link between Irish inflation and international inflation that holds even when we kick out maybe the more volatile components of energy and food. So this kind of indicates that there might be deeper structural integration at play, although obviously you can have pass through to other sectors. Now, despite this strong overall link, I find there's significant heterogeneity in these co-movements over time, and there's significant heterogeneity over indexes and components of subcomponents of inflation, right? Now, despite these fluctuations in inflation co-movements over time, I find that international inflation continues to exert a strong gravitational pull on Irish inflation over the long run and indeed over sub-intervals, right? Now, although this isn't necessarily the focus of the study, in additional checks, I find that international inflation is actually a stronger anchor or attractor than the ECB 2% target. And in a different paper, I find that this is true more broadly for the euro area. So it'd be good to get maybe do some future studies on that and get a deeper look there too. So this gravitational force of international inflation, it strengthens over time for Ireland with the rate of adjustment in the inflation gap following an upward trend. And this is particularly pronounced in the lead up to the global financial crisis. I find that goods are more responsible for upward pressures in this rate of adjustment, while services are more responsible for downward pressures. And that kind of perhaps reflects the discrepancy in the degree of tradability across the two. Moderate to large inflation gaps exhibit almost no persistence, while small deviations from international inflation are characterized by a huge amount of inertia, well, a significant amount of inertia. So the half-life, which is defined as the amount of time it takes for a unit impulse to dissipate permanently by 50%, that's often in excess of 12 months for those small deviations, right? So what I find is this kind of pattern in persistence over inflation gap sizes that bears some resemblance to ideas originating in the opportunistic approach to disinflation, in the sense that you get more aggressive corrections to Irish inflation whenever you have larger departures from international patterns. And so basically, conclusions about idiosyncratic inflation persistence need to be a bit more nuanced. It's not so black and white, it's state dependent. And perhaps what's allowing these small deviations to survive is the existence of these potential market frictions that become more binding at this small gap level and that impede transactions across countries. So I find that there is an inverse link between inflation co-movements and inflation gaps, while there's a positive link between the co-movements and persistence. So that latter link might seem a little bit counterintuitive, but we can rationalize it by noting by recognizing the nonlinear nature of idiosyncratic inflation dynamics over inflation gap sizes. So put simply again, when the co-movements strengthen, the gaps become weaker, they become smaller, and these gaps, smaller gaps by our nonlinear framework, which is backed by the data, indicates that they are more persistent, okay? So I find that there is a rapid increase in these inflation co-movements in the lead up to the global financial crisis, and correspondingly a narrowing of the gaps. Post-GFC, there is some waning in these co-movements and some reversal in these deviations from international inflation. Meanwhile, idiosyncratic inflation persistence over the long run follows a downward trend, and that's because the effective rate of adjustment is increasing over time. So you might ask, well, Adnan, if by the end of your sample your inflation gaps, say, are smaller, shouldn't that mean by your nonlinear model that persistence is higher? Yeah, but this is more than offset by a weakening of market frictions over time, which results in a higher rate of adjustment for a given inflation gap. Okay, and that perhaps occurs as over time as Ireland becomes more open, as it becomes more integrated into international markets and global supply chains. So I find that a number of factors, including higher trade openness, relative economic size, they tend to weaken these deviations by strengthening the co-movements. However, their impact on persistence ex ante is not so clear-cut. And that's because persistence is a function of two components. The first being the rate of adjustment for a given inflation gap, and that's something that's dictated by market frictions. And then the second factor being the absolute size of the inflation gap itself, and that's governed by the nonlinear model. So these two things together form what's known as the effective rate of adjustment. On the one hand, our factors, they increase persistence by making these inflation gaps smaller. On the other hand, they reduce persistence by weakening market frictions and increasing the rate of adjustment for a given inflation gap. So whenever you have these kind of opposing forces across these two channels, the question is which one dominates in the sample? Is it the gap channel or the adjustment channel, right? So I'm not going to spend too much time on the literature. These are the three core strands of the literature on which my nonlinear framework is based. There are three studies that are really closely related to mine. So I have a broader study that focuses on advanced and emerging market, but it's done at the aggregate level for headline and core inflation. Now, there are these two other studies by Shirley and Lejean and Stefan Gerlach and Rebecca Stewart. They are also conducted at the aggregate level. However, they employ linear frameworks, right? And so they ignore state dependence, and that's partly the reason why they reach opposing conclusions on idiosyncratic inflation persistence. So, you know, my framework is highlighting kind of the importance of these nonlinearities. Here are some interesting papers on some of the potential drivers of inflation co-movements, gaps, and so on. And broadly speaking, these can range from common structural trends and policies to the international propagation of inflationary or disinflationary shocks via real and financial channels. All of these factors, theoretically speaking, they have ambiguous effects. So you might look at, say, I don't know, trade openness, and you might say, well, the impact there on co-movements really depends on which one of the opposing forces of inter-industry trade and intra-industry trade dominates in the sample. So that depends on the output composition of Ireland relative to other countries, depends on the input-output linkages across heterogeneous industries, and so on. Then, you know, giving you another one, relative economic size. You might think, well, by gravity models, as the country becomes larger economically, shouldn't it co-move more with the rest of the world or other large countries? Right? But then on the other hand, you might say, well, the larger the country is, maybe they might have a larger government, and so a larger role for non-tradables, and so the inflation dynamics or price dynamics might be pinned down more by domestic or local conditions, right? So we'll have a look at that later when the results come back. Okay, so here comes the, I don't know, maybe the scary part. Here I'm going to talk a little bit about how I model idiosyncratic inflation dynamics. I'll try to make it kind of as simple as possible. So this is kind of a univariate time series model. And I look at this for headline, core, goods, and services inflation. So for each of those, why is the idiosyncratic component of Irish inflation? Simply, it's just a difference between Irish inflation and international inflation. That's it, pi and pi star. I'll define pi star later. DM are monthly dummies, and they're capturing seasonal effects. I'll talk about the frequency of the data later as well. There's a linear component and a nonlinear component to the model. The nonlinear component is in the brackets or parentheses times the transition function f. The transition function f is really what governs the nonlinear behavior here. It's what allows the bigger inflation gaps to have rates of adjustment that are different to those of smaller inflation gaps. And then the error term is just a composite error term. It includes all of the various shocks that I don't differentiate across because fundamentally the idea is, well, if Irish idiosyncratic inflation converges to something over time, no particular shock should impart a permanent effect. And this is estimated by nonlinear least squares. That's equivalent to maximum likelihood estimation if you assume that the errors are normally distributed. Now, the transition function depends on this transition variable yt minus d with delay d. That's kind of reflected by stickiness. So it's very much kind of reactionary. It's emphasizing maybe adaptive expectations, if you will. And it's conditional on these two parameters, mu, which is the equilibrium inflation gap, and gamma, which is a transition parameter that just tells us how easy or difficult it is to move across regimes, right? And the square deviation here is scaled by the variance of this transition variable. So I just do that to produce this dampened gamma tilde parameter. That kind of eases potential numerical issues in the optimization algorithm. And it helps to speed up conversions in the parameters. Like, fundamentally, the idea is as this gamma becomes really big, the transition function heads towards an indicator function, and then it can become difficult to capture these more realistic, smooth transition type dynamics that we want. And so I do it for that reason. At the other end of the spectrum, as gamma becomes small, you head towards a linear framework. So gamma, I guess, is also useful when saying something about the relevance of nonlinearities. So the dynamics of the model are given just by a weighted average of dynamics across the extreme inner and outer regimes at f is 0 and f is 1, where you have the small or 0 gaps and the really big gaps. And that implies then that the effective adjustment dynamics are just captured by phi plus phi star times f. So just for intuition, if we say that the equilibrium inflation gap is 0, then as your inflation gap in absolute terms becomes big, f goes to 1, and the more your dynamics reflect the dynamics of the outer regimes of the model. Conversely, the smaller the absolute value of y is, or your inflation gap in absolute terms is, the smaller f is, the closer it is to 0, and the more the dynamics of the model reflect the inner regime dynamics. Okay? So this is how I capture idiosyncratic inflation persistence most of the time. It's just absolute value of 1 plus that effective adjustment coefficient. But before you can talk about persistence in a meaningful way, and perhaps other measures of persistence, you need to check for the global stability of the model. So while I don't impose any particular restrictions in the parameters, I allow the data to speak completely freely. So to illustrate, well, it's possible for me to have random walk or even explosive kind of dynamics around the local neighborhood of the extreme inner regime where the gaps are 0 or small. These must be more than offset by convergent behavior in the outer regimes for the larger gaps, so that the stability conditions hold, and this primary one here holds between -2 and 0. And then you can talk about different measures of persistence. I can adopt kind of the more intuitive measures like the half-life from the literature that's used for linear frameworks. So I've kind of adjusted it here so that it's computed conditional on percentiles of the transition function, which are measuring kind of inflation gap sizes. Now, this assumes kind of a monotonic rate of decay, which might not be kind of the best thing in the case of higher order models. So it's always good to also look at your generalized impulse response functions. That's what I do. I conduct extensive dynamic stochastic simulations here, and by the law of large numbers, I should get what I want. And ultimately, the results here are very similar. The conclusions are exactly the same as for this kind of simple approach with the half-life formula and tree. So I just stick with that simple approach, right, just for convenience. Okay, so these are the 4 variables of interest, and this is how they're going to be measured. International inflation co-movements, so that's the 4-year moving correlation between Irish inflation and international inflation. And the inflation gap is measured by the transition function f, and that's a standardized measure of the absolute inflation deviation. That is good. That f is a good measure because it allows for comparisons across indexes, across countries if you want. And the rate of adjustment in the inflation gap, that's captured by the phi and pi star coefficients. They're time varying. How? Well, it's because I estimate that E star model over moving windows or rolling windows, 7.5-year windows to be exact. And then persistence, that can be measured either directly through those half-lives of the previous measure that I mentioned, or indirectly through just the effective adjustment coefficient. So regarding the drivers of cone movements, gaps, deviations, and persistence, they're all examined in multivariate time series regressions. This is all estimated by OLS, UE West Standard errors, and they enter this X vector here in lag and log form. So you have elasticity interpretations there. The other thing is it's on an equation by equation basis, so it's equivalent to SOAR, a seemingly unrelated regressions approach here because the covariates are the same across the equations. And the other thing that's important to note here is, in addition for the inflation gap, I look at a binomial or a logit framework, which might be more appropriate for Ireland, given that it visits both the extreme inner and outer regimes of the model at f is equal to 0 and f is equal to 1. So what I do is I define a new dichotomous dependent variable here that equals 1 whenever we have relatively large gaps corresponding to f is greater than 0.5, and I set it equal to 0 whenever we have relatively small gaps corresponding to f is less than or equal to 0.5. And then in the statistical version of the model, you have the effects of the law of odds. You can get the odds ratios for given percentage changes in the regressors, and you can compute the marginal effects on the conditional probability of a relatively large gap. And then, as I mentioned previously, with the gap being, with persistence being decomposed into the gap and adjustment channels, you can see how the drivers are acting through those different components to produce the net effect on persistence. Okay, so the data. 38 countries overall, mostly advanced economies, including Ireland. I calculate month-on-month inflation rates using data from HICP data from Eurostat over the period 1996 to 2025. So the reason I use month-on-month inflation rates is in order to avoid the temporal aggregation bias issues that have been stressed in the literature. So if you use quarter-on-quarter or year-on-year inflation rates, that can lead to an upward bias in your persistence estimate. It can also result in an exaggeration in the cone movements. So that's why I do that. And I use the European classification of individual consumption according to Purpose 1 data from Eurostat. Some of you might know the version 2 data came out earlier this year. So those are now aligned with the updated UNCOI-COP 2018 classification scheme. So some adjustments to certain definitions of classes and subclasses of goods and services have made some adjustments there, including the way subscription services are accounted for and tracked over time. Now, I don't use those data. Why? Well, because they have far inferior time and country coverage, so I would lose a lot of observations. And moreover, for the indexes that I use across the 2 repositories, I don't see much of a difference between them. Even for the disaggregated data, the differences only show up really in the 2nd and 3rd decimal places. International inflation, it does not include Ireland. So the measure does not include Ireland, and I'm consistent with the literature on that. So you exclude the country that you're analyzing in order to avoid endogeneity issues, a potential spurious relationship But to be honest, that's not going to matter really for Ireland because it's a small open economy. Most of the time it's a price taker. So I don't find empirically that it does matter. But that would be the argument. And then there are 6 different measures of international inflation that I look at. So I look at the median inflation rate over the cross-country of foreign inflation rates. I look at the average inflation rate, the GDP-weighted average inflation rate. I look at the principal component, the leading principal component in foreign inflation rates. So this uses the full variation in the inflation data, foreign inflation data, and tries to reduce it to a single dimension of the data. I use a single factor model, right? So a single factor is used from that model, and that relies solely on the common variation in the foreign inflation rates. We attempt to capture that in a single index. And then finally, I have a Eurostat aggregate index, specifically an EU index to capture international inflation. And then the covariates in these multivariate time series regressions, they use quarterly data because of data limitations on the right-hand side of the equation. The covariates are all pretty standard. The only one that I'm going to highlight here is the ECB inflation target. So the role is captured by looking at the volatility of Irish inflation around that target and seeing what the implications are. Okay. All right. So here I have some plots of month-on-month and year-on-year inflation for Ireland in the case of headline, core, goods, and services inflation. So if I look at headline, core, goods, and services inflation, generally speaking, like qualitatively, the patterns are similar over time, with 2 major spikes evident over the past 2 decades. We have one pertaining to the Great Recession, and then the other pertaining to COVID and the energy prices originating in the Ukraine-Russia war. However, if you're looking at kind of the data more precisely, you're looking at magnitude, range, volatility, and persistence. Clearly, there are differences. So compare headline to core inflation, look at that energy crisis period, the Ukraine-Russia war starting point. Clear difference between headline and core inflation. So that's highlighting the direct impact of global commodities. And core inflation excludes these the energy and feed components. Now, if you compare goods to services, so whether it's industrial goods here or non-energy industrial goods, you can see that services tend to exhibit a little less maybe variance and maybe a bit more persistence. That's because services are more non-tradable, more labor intensive. If you look at that COVID period, what happened there was you also had some expenditure shifting away from services towards goods, and at the same time a collapse in the supply of goods due to disruptions in global supply chains, right? So you get that discrepancy at least initially, and then you also have lag pass-through to services. So, created a bit more persistence, I suppose, there for services. And the other kind of salient point that emerges from these graphs, and I know Kevin would probably be interested in this, is that month-on-month, it takes time for month-on-month inflation to embed itself in year-on-year inflation because of base effects, right? So if you're looking at the year-on-year figures, persistence may seem higher than what it actually is. And that can kind of de-anchor inflation expectations and create entrenched mindsets amongst consumers and firms. So there are a number of papers in the literature that say sometimes looking at month-on-month inflation is better because it provides you with a better idea of the direction in which the economy is going. So especially during crises. Okay. All right. So here I have some full sample period correlations between Irish inflation and international inflation for the various consumption baskets and indexes. They're in the first column, and for the different measures of international inflation going from columns 1 to 6. And FPC is the first principal component measure, SFN is the single factor model measure, and then NDX is the Eurostat EU index measure. Now, for headline, core inflation, overall goods, overall services, the correlations are relatively strong. And if you square these correlations, you actually get the kind of this four squares from simple linear regressions of Irish inflation on international inflation, which gives you a rudimentary gauge of how well domestic fluctuations are explained by international patterns. So for those indexes, the typical correlation there is around 0.7, which means that around 50% of the fluctuations at home over this time period have been explained by international trends. In addition, in column 7, I have an R squared from a regression, a multivariate regression of Irish inflation on foreign inflation rates. Those are also quite high, but they're often used as the upper bound on the explanatory power of your single factor model. So if you compare 5 and 7 for, say, total all items HICP index, well, column 7 tells us that foreign inflation rates explain around 75% of fluctuations in Irish inflation, okay? And while column 5 says that the single factor model explains around 50% of those fluctuations, right? So the single factor model is able to capture around 2/3 of the explanatory power of the foreign inflation rates, which is, you know, non-negligible, I suppose, amount. It's a good figure. So if we look at the different components, if you look at energy overall, the correlation, you won't be surprised to see, is quite high. So this is the correlation with the international counterpart. For electricity, for liquid fuels and lubricants for personal transport equipment, they're also very, very high, even more pronounced. So, you know, people can relate to that definitely. However, at the other end of the spectrum, if you look at household electricity, gas, solid fuels, heat, those correlations are quite low. And the reason for this is, you know, there are a number of factors that you could point to. So you could point to Ireland's relatively dispersed population, you know, which makes distribution and maintenance costs higher than in other places. You could point to Ireland's relatively less diversified energy portfolio. We're heavily dependent on gas given our infrastructure, right? Although, you know, we don't have that many connections to Britain and the continent. The Greenland interconnector and the Celtic interconnector are indeed steps in the right direction, so we need more of that. Then you can also point to kind of the long-run hedging strategies of energy suppliers, which act to decouple markets. You can also point to government interventions at times, which create a wedge between the prices in our utility bills and those prices on the market. And you can also talk about, I suppose you can also talk about the data centers that we have here. They use up a lot of our energy too. So we're an outlier in that respect. I think over 20% of our energy is used by the data centers compared to a world average of around 1.5%. So the overall correlation on energy does feed into the headline figures, the core goods and services figures. But if we take energy out of the equation and you look at overall HICP without energy, you can see that the correlation is still high. You exclude food, you know, the correlation is still high. So perhaps deeper structural integration is at play there. If you look at non-energy industrial goods, correlation is still high there. But you might say, well, food is also not present there. So, you know, how's food interacting in this? Okay, so if you compare goods to industrial goods to non-energy industrial goods, you can conclude that energy is creating upward pressures on that correlation, while food is creating downward pressures. And if you look at food directly, you can see that the correlation with the international counterpart is relatively low, a little bit higher for processed foods and unprocessed foods. That's because of the energy intensity of the former. But a number of factors could explain that. So firstly, our trading relationship with the UK, you know, we're a bit more sensitive maybe to trends over in the UK than elsewhere. All of this may have dissipated a little bit or may have diminished a little bit post-Brexit because of global value or our supply chains shifting away from the UK. We have UK retailers as well here. You can talk about maybe the labor intensity of food, so that makes it more kind of related to domestic dynamics and conditions, maybe sticky wages. the geography of the country. So that means that basically our logistics and distribution costs are more dependent on maritime constraints than maybe the land-based networks of that other countries are dependent on in the continent. And then you can also talk about the concentration of the industry or the market. You talk about competition, how that's evolved over time. So currently we have 5 major players in the market controlling 90% of it. Back in 2010, Tesco, I think, had over 30% of the market. It acquired crazy prices, if you recall, in the mid to late 90s. Then you had Lidl and Aldi entering the market in the 2000s, early 2000s. So there's a bit of the evolution here has been different than that on the continent. The other thing that you can point to is the groceries order, if anybody knows about it, from 1987. So that said basically that you couldn't charge prices below invoice price, below cost price, and it was there to protect the smaller outlets, the smaller retailers. That was abolished in 2006, right? And so post-2006, you saw a bit more volatility in the market relative to other places. Why? Well, because the outlets or the retailers were adopting these loss leader strategies, right? And to offset some of the losses, they were charging higher prices on other brands, right? So therefore, you got that kind of volatility, which may have decoupled our market from others. Okay, and then if you have a look at services overall, relatively high correlation with international counterpart, particularly for recreation services and transport services. But if you have a look at housing, rentals, finance and insurance activities, those correlations are relatively low, almost non-existent, partly related to our domestic legislations, kind of maybe also the structural market issues that we have here, specifically pertaining to housing and the supply side. It's important to note, I guess, the rentals that we have here, those are actual rentals. They don't include imputed rentals for owner-occupiers, right? So given that, although the ECB is working on that particular issue, so given that Ireland has more of a home ownership culture than other countries like Germany and Austria, which have more of a tenant culture, right? We receive a lower weight on the rentals in our overall HICP relative to those countries. And that can actually act to increase the co-movements, okay? Given that, our rents are a bit of an outlier in the distribution. Okay. Oh, my right side now. Okay. All right. So, which measure do I want to use going forward for the core analysis? That's why I have this correlation matrix of the different measures up. And as you can see, it's not going to help me that much because all of them are very highly correlated. So what ultimately tilts my preference towards the median rate of inflation is that it's an easy to compute, non-parametric measure, robust to outliers, used extensively in the literature, so good for comparisons. And it's very highly correlated with the other measures, as you can see. So I don't really have much of an issue with that. Okay. All right. So here I have some kind of initial tentative evidence on asymmetries in Irish inflation adjustments and volatility over upper and lower inflation gap regimes. The upper inflation gap regime here for a given index is characterized by absolute inflation deviations at time t minus 1 that are greater than the average absolute inflation gap, right, over the entire sample period. And that's marked by the threshold parameter tau, okay? So for each of these two regimes, so the lower regime has the opposite definition. So for each of these two regimes, I then go ahead and I compute the average absolute monthly change in Irish inflation and the corresponding volatility of those changes. So what emerges from this table is that the upper regime figures are all greater than the lower regime figures, right? Which suggests that international inflation is exerting a stronger pull on Irish inflation whenever we have larger departures from international trends. The other thing that you can see is that across the indexes, you see some differences. The figures for core inflation are stronger, and that's because of the exclusion of the food component, which we saw has a lower correlation with the international counterpart, right? So those dynamics might be pinned down more so by country-specific characteristics. We also see that services have lower figures than for goods, and that's because they're more labor-intensive, more non-tradable. We also saw that the services correlation with the international counterpart was a bit lower than that for goods. Okay, so here are the E-star model results. The gamma estimates here in column 4 indicate that nonlinearities are relevant. They're all greater than 0. The mu parameter is the equilibrium inflation gap. So that is 0 over the long run in all of these cases. It's also 0 over most subintervals. So if the Irish inflation gap is converging to something over time, that something is 0, okay? The phi parameter is absent because the inner regime I find is best characterized by random walk behavior. So I just go with a more parsimonious framework that's set to 0. And that means that the effective adjustment dynamics are just going to be captured by phi star and the transition function f. So phi star it satisfies that earlier stability condition. It's between -2 and 0. More specifically, it's between -1 and 0. So the interpretation there is within that -1, 0 interval, as it becomes smaller or larger in absolute terms, the higher your rate of adjustment is towards international inflation, basically. These are the persistence figures going from columns 6 to 9 for relatively large gaps, as captured by the 99th percentile of the transition function. The half-lives are all very, very small, less than 1 month, less than 2 months. And there's some increase in those half-lives when you move to moderate-sized inflation gaps, as gauged by the 50th percentile and mean of the transition function. So the half-lives now are less than 3 months, a little bit higher. And it's only when we get to the 10th percentile really and lower of the transition function for these small deviation that we get to see a notable amount of persistence in excess of 1200. So persistence increases as the gaps become smaller, and it's maybe these market frictions that are allowing these gaps to survive as we approach these levels, right? So the market frictions become more binding and they impede these international transactions. Core inflation, you can see rate of adjustment is higher, persistence figure is generally lower, and goods are more responsible for upward pressures in the rate of adjustment. So you can see that the adjustment coefficient here is higher in absolute terms, and then for services it's lower. So services are placing more downward pressure on the overall rate of adjustment. Okay, so this table here paints a relatively static picture. It paints a picture of what's going on average. The next natural question is, well, what's happening over time? Is there any heterogeneity as things evolve over time? And that's what we try and look at with these graphs. So on the left here, you have the inflation co-movement, the co-movement between Irish inflation and international inflation over time. So the red horizontal line is the average 4-year moving correlation, and the blue horizontal line is the median 4-year correlation. I'm not going to spend any time on the transition function. That's plotted against the transition variable, so the gradients are all pretty decent there, which means basically that you can move relatively easily across regimes. And then the transition function here is of relevance. That's plotting the inflation gap over time here on the right-hand side. So we can see that Ireland visits, generally speaking, both the upper and lower regime of inflation gaps, corresponding to f is greater than 0.5 and f is less than 0.5, right? So we have relatively large gaps and relatively small gaps over time. This red horizontal line or series, that shows the 12-month moving average of the transition function. And it's important because it gives us an idea of the general direction in which the inflation gap is going over time. Okay, so the beta parameter is also important because that gives us the correlation between the inflation components on the left and the inflation gaps on the right. So in all cases, these are negative and statistically significant, which means that as the co-movements strengthen, so between Irish and international inflation, of course, the gap or the deviation from international inflation weakens and vice versa. So what's happening for Ireland? Well, across all indexes, what you can see is the co-movement increases quite rapidly in the lead up to the global financial crisis, and there is a corresponding kind of decline in the inflation gap. Post GFC, you have some deterioration in these co-movements and some reversal in the gaps, right? So why is this? Well, pre-GFC, you have Ireland entering the euro area, so it's following the economic convergence criteria. There's also this hyper-globalization period, right? So you have improving technologies that support global production, which is relying on international or global labor supplies, right? You have relatively low risk aversion, low levels of interest rates globally, a boom in global capital flows, including the credit boom here that fueled the construction sector. Post-GFC, you have a reversal in most of these kind of conditions. You have this adjustment in external imbalances. You have the trade collapse of 2009. You have the capital market fragmentation effects of the European sovereign debt crisis, right? So global capital flows have actually never recovered to their pre-crisis peak, right? And that's partly related to government bailouts and macroprudential policy, persistence in higher levels of risk aversion, right? And you can also look at the trend in the share of services for Ireland. That's been going upwards since the GFC. And if those are more non-tradable, then those could have also impeded the co-movements. Right, not to mention the other events of Brexit, Trump 1.0, Trump 2.0, right? So increased levels of protectionism, rising geopolitical tensions, and COVID, all of which may have deteriorated or damaged integration. There's literature out there similarly highlighting that they've had adverse effects on trade and financial markets. Okay, so this period post GFC is often referred to kind of as a period of deglobalization. I don't like that terminology. I prefer to say that it's a stagnation in globalization or a slowdalization. So we can illustrate this just by looking at international financial integration for Ireland, right? So this includes all of the distortions and I guess the effects of globalization, which is the point. And if you look at kind of the volume of total assets and liabilities, foreign assets and liabilities relative to GDP, you can do it for modified GNI as well on the right, but I'm going to stick to the graph on the left. In 1996, that ratio was 5.4. By 2007, it's 27.6. So that's a five-fold increase, huge growth. Post-GFC in 2009, it's 32.4. By the end of 2025, it's 34.6. So there's growth there, but a significant stagnation. And you can point to denominator effects in the strong growth of Ireland, but still, it's a stagnation, right? So kind of related to that, if you have a look at the rate of adjustment in the inflation gap over time, so this is based on different estimates from IB-star model, the rate of adjustment in the inflation gap as captured by that 5-star coefficient is trending upwards over time, right? Because the 5-star coefficient is trending downwards, which suggests that market frictions have been weakening over time for Ireland, right? Perhaps as it's become more embedded in international markets. The effective rate of adjustment, which takes into account the absolute size of the inflation gap, also follows a similar trend, which suggests that the adjustment channel has been more than offsetting the gap channel over time, right? So in that pre-GFC phase, for example, as the co-movements between Irish and international inflation strengthened, those deviations weakened and persistence increased. But this is more than offset by the weakening of market frictions and the increase in the rate of adjustment as indicated by that downward trend in pi star. And if you look at idiosyncratic inflation persistence as measured by the half-life, you can also see that huge decrease in inertia and deviations from international inflation, right? So those have become less and less persistent over time as Ireland has become more and more integrated into international markets. Okay, so here I have the analysis of some of the potential drivers of inflation co-movements, inflation deviations, the rate of adjustment, and idiosyncratic inflation persistence. So from the first two columns, what you can see is that a number of factors are positively associated with the co-movement between Irish inflation and international inflation, okay? So in turn from columns 3 and 4, you can see that by strengthening those co-movements, those factors weaken, generally speaking, the deviations. And you can also see that from the logit framework here, same factors have negative coefficients, they have odds ratios and square brackets that are less than 1. So if you take, for example, trade openness, when that goes up by, say, 5%, the co-movement strengthened by 3.6% on average, the gap falls by 4.3%, around that. And in the logit model, right, the odds of a relatively large inflation gap are now halved, right? So they fall by 50%, and the marginal effect on the conditional probability of a relatively large gap, that's minus 8.8 percentage points on average from columns 2 and 4, respectively. So these gaps are now smaller because of these factors when they go up, and persistence increases along the gap channel. But we know that these factors can also influence persistence through the adjustment channel, and that's what columns 5 and 6 look at. And so these factors have, as you can see, mixed effects on the rate of adjustment. But if we're sticking with trade openness, we can see that that 5% increase in trade openness, it increases the rate of adjustment corresponding to a 2.5% decrease in persistence. So it's measured in terms of persistence here, right? And so you have now opposing forces across those two channels, and the question is which one dominates, right? So you have an increase in persistence here, decrease in persistence here. This is the gap channel, this is the adjustment channel. And the answer to that question from the net effect is given in 7 and 8. So when trade openness goes up, idiosyncratic inflation persistence goes down by 3.7%. And so, there are some other interesting findings here too. And I guess the nice thing about the framework is you get this additional underlying intuition from the decomposition. For financial openness, the rate of adjustment it increases due to a weakening of financial market frictions, but the gaps widen. Why is that? Well, when you have greater access to international capital markets, you can run more persistent current account surpluses, current account deficits, and as Philip Lane and Vahan and Galsniad have recently documented, those can be associated with divergent inflation trajectories. The share of services, somewhat surprisingly, there is a positive link there between that and the co-movements. But that's primarily led by the pre-GFC phase, where you had that kind of hyper-globalization phase. Perhaps the rise of multinationals also influenced that. Post-GFC, it collapses, and more kind of in line with our intuition, we can see that the rate of adjustment for a higher share of services slows down, right? So persistence increases. For the inflation target, the ECB inflation target, what's interesting here is that the lower the volatility around the inflation target is, the ECB inflation target, the lower the co-movement with international inflation is. So that suggests that there's a divergence between international inflation and the ECB 2% target, right? Because if there wasn't, when you have that lower volatility, you would get higher co-movement with international inflation. The other thing that it suggests is that when you have this low volatility in Irish inflation around that 2% target, Ireland does a better job of sticking to the ECB mandate than other countries because it diverges, okay? So just to kind of reinforce what I've said, this moves. Okay, so just to reinforce things with a graph, because graphs are always great for intuition. Here I have some simulations of idiosyncratic relation persistence from the Eastern model. So the parameters are tuned to match empirical estimates. Phi is 0, and then phi starts between 0 and -1 is estimated. And basically for a given rate of adjustment corresponding to phi star, right, which is in line with a given set of market frictions, I plot the relation between persistence and the inflation gap. So when trade openness for Ireland goes up, the co-movements strengthen and the gap weakens. So along a given curve, we move to the left and persistence goes up. But we also saw that a higher level of trade openness is associated with a faster rate of adjustment for a given inflation gap. Why is that? Well, over time, transaction costs might weaken with higher level of openness, information asymmetries, familiarity bias, all of that tends to weaken. So what you get is now a shift in the curve downwards. So for the given inflation gap, persistence is now lower. And the question is it the shift in the curve or the movement along the curve that dominates? And of course, we saw it was the shift in the curve. Now, it's not always so ambiguous. In some cases, persistence moves in the same direction along both channels, right? So if you look at uncertainty, for example, higher levels of uncertainty increase co-movement between Irish and international inflation. So why is that? Well, because of spillovers and contagion from larger economies to Ireland, that tends to weaken the gaps, right? So you move to the left along the curve, persistence goes up. What about adjustment? Well, higher levels of uncertainty are associated with greater persistence or lower levels of adjustment. Why? Higher levels of uncertainty delay consumption, investment, production decisions, most consumers, firms, households. So this has the impact of shifting the curve up. And so for a given inflation gap, persistence is also higher now. So it's unambiguous. In both directions, persistence goes up. And that's exactly what we see for the overall effect. Uncertainty, have an increase in persistence overall. Okay? So to conclude, I'm not going to go through all of the results again, right? So I've had a look at the impact of international inflation on Irish inflation over time, and the impact is significant, it's particularly pronounced in the lead up to the global financial crisis, some weakening of this post-GFC, and we primarily analyze this through this kind of framework that looks at a link between co-movements, gaps, deviations, and the rate of adjustment. And then we follow that up with an analysis of some of the potential kind of covariates or drivers of these co-movements and gaps. So just two kind of broad comments going forward as kind of food for thought. So there's been a lot of kind of discussion about the adverse effects of this stagnation, globalization, and fragmentation, and how we can combat this. So we've seen some of the recommendations in the Draghi report, which have been subsequently adopted in the EU's competitiveness compass. So we're told to try and reinforce existing trade ties, maybe form new trade ties as well within new trade blocks. So Ireland has had some discussions with China. EU has, formed new deals, I think, with India, Mexico. We've seen the Mercosur deal as well. At home, we're told to support local skills and innovation initiatives, and also to support investment or reinforce investment in critical underlying infrastructures like IT and energy, in particular renewables. Denmark has, for example, done a great job of that. 90% of their energy comes from renewables. So the point, I guess, here is, while these fragmentation effects may kick in, and if these fissures open up in the global economic landscape, they really widen, then Ireland will indeed be placing more weight on national policies. Perhaps as it tries to become more energy independent, it tries to reduce its kind of over-reliance on foreign multinationals. this might be a good thing, right? And I guess the other thing is all of these global co-movements may weaken. The regional co-movements within particular trading blocks may strengthen, right? With blocks divided by new sanctions or protectionist measures. So going forward, it will be interesting to see the extent to which these regional co-movements change and strengthen relative to declining or weakening aggregate co-movements or global ones. Okay, so thank you. I think that's the presentation done. Anybody interested in a quick summary again? It's the last two slides. Okay, and I have an appendix here in case any questions come up, because there's some other material there too, but that's pretty much it. I didn't know there was a couple of comments into the chat as well. People had to dial off the base, so there we go. But you can see the start of the point already.
Just two both thanks to Mark Morton.
Yeah.
Thank you. For the paper. I'm Mary Doyle. Interesting implications in the role of domestic government interventions.
Yeah.
The follow-up.
That's simple. But we might take a few minutes for questions, and we check online if there's anything for Adnan as well. Yeah, thanks so much. Yeah.
Thanks, Adnan.
Yep.
So, only a couple of small queries on some of the data side. So, eCoiCop too. Like I've sort of found that it has, in Ireland's case at least, a bit of a better. Like I used to have to stop in 2000 when some of the solutions it would actually go further back from Ireland. But maybe as for your general panel, it's not.
No, it's very, very imbalanced.
Yeah.
Yeah.
I mean, I wouldn't have a problem if you mishmash the two. But anyway.
I did do that, and I like your thinking, but it is a bit of a nightmare. And I was told by people that work in the ECB that it's going to take some time to maybe clean this up a little bit.
Yeah.
But the problem is, right? So you end up with a lot of missing data prior to, I think, 2001 to 2002, and you end up with some countries that are completely missing, right? The one index that I do use from the version 2 data set is for finance and insurance activities, because the aggregate for that is not available in the version 1 data. So I did kind of, take your advice on board in advance.
Yeah, fair enough. And the GDP weighted one, I wonder why you wouldn't do PCE weight, because like that's effectively what Eurostat's doing, isn't it? Like it's kind of a
the US looks at PCE, right?
Yeah, but it's when it's aggregating to euro area inflation, like, and you can do that without Ireland, obviously. Just PCE is a kind of a closer proximate to it than GDP is my sense of it for weights.
Yeah,
not a big deal, but
you think it would make much of a difference?
Probably not. No, but and then the last one is loads of data in the tables already, but and it might not work further back. It probably doesn't, but like the Bank of England's definitely moving towards a new category of services, which is excluding indexed and volatile. They've had iterations of it. They call it like super core services now. And it's trying to get at what is underlying services pressure, because some services are kind of volatile month to month, like airfares bounce around like 10% month to month. Some are indexed, so like the April inflation in the UK plummeted on the back of government policy, effectively. So you could get at super core services. There is an ECB equivalent, I think, where it's trying to get at kind of more domestic service.
So that measure, right? I would need that for the full 38 for a large number of countries, right? So you're saying the Bank of England would have those indexes available, or is it just for the UK?
I mean, you can get at it for the Eurostat side across every country. It's just you might only get to start it in 16 or something. It wouldn't go that far back. But like I think in a forward-looking sense, that is kind of a useful framework to where the threat is nowadays. It's super core services there.
Yeah,
it seems pretty useful for the UK and Euro areas.
Yeah, no, that's a valid point. But again, services could include so many different things, ranging from rentals and so on. And I think, so the question is, if you were to include that kind of measure or look at it, what would the implications be for the co-movements between the Irish measure and the international measure? So do you think the pattern would change there?
I actually have no idea is the thing, but I think it's just one extra thing to be included potentially.
Yeah.
That's all. I don't know what it would look like.
Okay. No, that's interesting. Thank you. So it's Bank of England, you say that they have a...
Yeah, and an ECB version too. Yeah.
Okay. Thank you.
You'll check online, but go to Paul first, yeah, thanks, Paul, yeah.
Congratulations on the prize and an excellent paper. This could be not related, but I keep going back to competitive index, like the price of traded over non-traded, exchange rates and stuff, right? And I'm just kind of wondering how your results could be used to kind of explain movements in real effective exchange rates or competitiveness. You know what I mean? I'm just kind of wondering, is that sort of idea of a non-traded sector and traded sector gone in a way, and that it's not really possible to do this? And then a related question is, when I'm looking at these gaps, am I trying to pick out potentially sectors, let's say at a much more refined than food and energy, where competition policy might need to be deployed, right? Because there are abilities for some reason to have persistent markups, and market power, particularly, across different sectors. It could be pharmaceuticals, for example, right? Cereals or something related to cereals, right? But just this technique, how can you deploy it to get it, say, market power issues and really effective exchange rates?
Yeah, I mean, I'll take your second point first, just regarding inflation gaps in the energy sector. But you would really need to dig deep there for energy, for example, because you have the wholesale end of the market and then you have the retail end. On the retail end, I think we have plenty of competition. On the wholesale end, that's kind of more so underpinned by world prices and international kind of markets. So we do have plenty of competition, as I said, on the retail side, and some of the companies that are involved in the retail side are also involved in the wholesale side, like energy and SSD electricity. But that would be an interesting point. So the inflation gap, right? So the idea is, the smaller the inflation gap is, the more aligned you are with your international competitors, right? So, the larger the gap is, the larger the discrepancy, and so potentially, you might be over competitive, or you might be not competing at the same level as the international players. So the optimal kind of goal would be to reach that international point or international level, right? It's obviously good if you're more competitive, but what we see is over time there's a convergence in this inflation gap towards zero, right? So the more integrated you are in international markets, in global supply chains. So I take your point, the inflation gap is and can be used as a kind of a measure of how competitive you are, but here is the absolute inflation gap that I'm looking at. So I would then need to look at the sign, whether it's positive or negative, to gauge whether I'm over competitive or under competitive, right? And then the earlier point, I think you're kind of thinking like Van Galstian now, right? And I have a bunch of papers of my own on this, right? Looking at kind of the long-run determinants of real exchange rates and relative prices. This is somewhat related. You could look at it from that point of view, the relative price structure of the country, so non-tradables versus. And I think Philip Lane also said recently that, to get any good inflation analysis, we should look at relative prices. So, I do look at relative prices here, but not in the traditional sense. And I guess if you wanted to make a correspondence between kind of the long-run determinants of the relative price of the non-tradable sector and this, you could, however, it's not like a one-for-one, I would say, because this is more so kind of focusing on maybe the short run with the inflation gaps, whereas with the relative price of non-tradables, and when you're looking at the Belassus and Wilson effect and those kind of things, that's the long run. Those are the long run determinants, and you're looking kind of like at a co-integrating relation. And then the corresponding short-run dynamics, you could look at, the extent of persistence there. So this is more so looking at that short-run component if you're particularly focusing on the inflation gap itself. Although there is kind of a correspondence, it's just that if you were to try and impose that framework, I don't think a co-integrating equation would be appropriate here, given that it's not a long-run thing. Yeah.
I have to take a final question online from Deirdre Toller, asking about the flexibility of this approach to producer price.
Yeah, that's a good
given our obviously the much better. And I knew when you mentioned it, but I hope somebody might start asking about producer prices.
Yeah. Again, it could be used in that sense, but again, you're looking kind of at a different part of the market or a different sector altogether. So I'm primarily just looking at it from the household point of view, from the consumer perspective. Now, you could do it for producer prices, and I guess you get some additional insight into, yeah. I haven't really looked at producer prices in as great detail. In the Eurostat, I don't know as well whether the time frame or kind of the sample size would be the same. Would go back to 1996. That's something I'm trying to remember now from where I looked at. No, I haven't looked at producer prices, and again, but I don't see why I wouldn't be able to apply that framework there. And I guess it would perhaps indicate maybe what the underlying core drivers or structural characteristics are.
Would be a different shape. Very insightful. Okay, you got into the presentation part of it and do the presentation. And many thanks to everybody joining us online as well as for a really, really interesting presentation and for the questions. And we have the air conditioning turned on high here. So the energy costs are not right. So they're churning through the electricity or gas or whatever they're carrying it. We just want to congratulate Adnan, and we have the beautiful presentation for the winner of Barrington. And just to say, for a fantastic amount of work, as I say again, repeat, really strong for you this year. So
Thank you very much. I found it a little bit warm in the room. I was happy about the conditioning, regardless of the cost.